So nice to meet some of y'all, probably for it's the first time, actually, some of y'all. So I don't get out of the office often. But yes, I am currently I just hang my license here at Lantern. Although I spend most of my time at Potter and Company doing some accounting. So mainly tax and also some audit stuff this time of year. And I've got with me Dan Morrow. He is our partner at the Concord office. And I'll let him kind of talk a little bit about our firm and what we do before we get into today's topics.
So yeah, Potter and Company, we've been right up the street here on Copperfield for 25 years in that office. Our firm has actually been around the Charlotte area for going on 60 years, a little over 60 years, and between the three offices. And just organically, we've do a lot of tax work in this area. So Chad and I had a lot of just chit chat in the hallway about some of the issues he sees and hopefully you guys see. And so we sort of, that's sort of where this whole idea sort of came from. We work with a lot of folks here in the area, a lot of small businesses and or individual tax filers. And when they buy and sell property, there's a lot of questions and either things we see ahead of time that we can sort of work with your clients or you guys specifically on, or obviously when you actually file the returns, there's some ramifications for your tax return. So we'll sort of talk about that too, but just a lot of things in this arena. And I think things that you guys might get asked from time to time. So we'll stick to sort of some of the more popular topics. And then please ask questions if you have questions, and we'll do some Q&A at the end too. So
yeah, absolutely. Yeah. And I've kind of highlighted some of the stuff I thought would be most relevant to kind of what we do as agents and how it maybe relate to you and your guys' clientele. So obviously the tax preparation, like you said, and that could be whether it's individual or you guys are operating as a business, even if you're with a group and you guys have a partnership, whether it's investments, either personally or through a business. Of course, we kind of like, not really to say like messy, but we kind of like the complex type of client where we can kind of dig into those multiple areas, your individuals and business stuff. And then also agreed upon procedures. If you don't know what that is, one of the things that's actually becoming very popular right now with the cost of construction are these general contractors going out and upping their licenses either to limited or unlimited. And part of that process for them is to go through an agreed upon procedures where they do a working capital calculation to make sure that they qualify for that through the North Carolina General Contractors Licensing. And we have kind of taken a hold of that little niche and specialized in that as well. So if you guys are working with general contractors who are looking to license up, or you yourself or family members are involved in those things, we also do a lot of services with that. Okay. So just before we kind of get started, I just kind of gauge the room, and you can put your answer if you're online in the chat on just like a scale of 1 to 5. How good do you feel about your tax knowledge? 1 being not good and 5 being like, yeah, I do mine every year and I could probably teach this.
2.5, 3.5,
3.5.
3.
Okay.
Yeah. It's all relative, like compared to who?
Yes,
the question really.
I'm curious to see chat 2, 2.5, right in the middle. Seems to be pretty similar. All right. Well, I'm right there with you. I'm just kidding. I'm just kidding. But no. So, and just to kind of ask this too, does anyone file themselves? About half and half. Okay, just curious. Okay, there's not a right or wrong answer. Just asking. So, before we talk about saving money on your taxes, might help if I clicked on the screen. We're going to talk about how you guys can help your clients first. So kind of how this is going to go, the topics we'll look at are how can we help our clients as far as buyers and sellers, what the differences look like as far as the accounting, what they need to make their accountant aware of. And then we'll also talk a little bit about investors. So as far as like rentals, and then we'll kind of look at Schedule C stuff like your personal businesses as well. Okay. So in regards to buyers, so if you guys are working with a set of buyers, whether it's single or married or any combination, one of the main things they need to do is make their client aware of when they close on a property. So providing that closing disclosure to their accountant is going to be pretty important. And you'll see there's 2 bullet points there that we're going to look at from that CD. Is we're going to look for property taxes that they paid. So maybe the seller had already paid for them and they're trying to make up for that, pay them back. And also any mortgage points or loan origination fees, which is not going to come on their standard mortgage interest statement sometimes, not always. Sometimes things are missed and it happens. So it's good to have that as kind of verification of if it were to show up. But what's even more important is when they turn around and sell that same property later, we're going to need that original closing disclosure. I'll talk about that when we get to the sellers too. So as you guys know, if you own a property, what do you get in the mail every year for owning that property and having a mortgage on it?
Property tax bill.
Yeah, you get your property tax bill and the mortgage interest statement, right? That 1098 MIS. All right. So just to kind of see what that looks like, as you may be familiar with, the main things we're looking at is the stuff in box 1, which is the mortgage interest that you guys paid on that. So again, talking to you as far as maybe you personally or your clients that are buying, this is something they need to be aware of because they could be first-time home buyers and they haven't seen one before. Okay, so they need to be on the lookout for it. And sometimes those lenders are not so fast at getting them to you, so they may try to file or get their tax stuff in because mom and dad's always done it before for them, or they just haven't had to. So just, things that we kind of take for granted might be overlooked. So think about that when you're informing your buyers and who they are. And sometimes even it'll list the property taxes on there. So you may not need to directly, let your accountant know like, hey, here's my actual tax bill for my property. Sometimes it's just listed on here, which is helpful too. But to kind of back up here, there is a small caveat with the mortgage interest statement. You might see the little asterisk there on the bottom where it says it's limited based on the mortgage principal, the date that it's purchased, and your filing status. So to kind of look at what I mean is, I'm kind of jumping around. There's actually a threshold of $750,000 on the outstanding mortgage of that home that you can get deducted. So anything above that $750,000 threshold is going to be prorated. Okay, so it kind of caps right there, and then it starts, getting prorated a little bit. So I know I'm shuffling back and forth, but this one, what's the outstanding mortgage on this one? 128,000. Well below that, right? So they can deduct that full $1,900 or $1,953 that's in box 1. If that outstanding mortgage is above that $750,000, then we have to actually go in and calculate a prorated amount. And basically it's as simple as you're taking, you can see the calculation here, $750,000 divided by what the outstanding amount is, which gives us, in this case, about 33%. And then we multiply that with the actual mortgage interest that they owe, which you can see in box 1 is $102,588. And if you're not good at math, that's okay. We do this, okay? Your accountant should be doing this, or their accountant should be, but it may be something you make your clients aware of if they're purchasing a home that's around that 750,000 or more, or some type of property. They might get upset when they look at their mortgage interest statement on their tax return, the amount that they got, and we're like, hey, that doesn't match up. Well, in this case, that's a pretty big difference, right? They're only allowed almost 34,000 when there's 102,000 on there. That might upset somebody, okay? But and hopefully their accountant is telling them that information as well. But if you're doing it on your own, that may not be as clear. Did you have something? to
Well,
add?
and this almost was irrelevant for years and years. A few years, 3-4 years back, they brought it down from 1 million to 750. And as you guys know, at the same time now with COVID, all of a sudden 750 is not that unheard of. I mean, in our area or, in this region. So we sort of lowered the applicable number and housing costs and the mortgages associated with it. So this has come into play quite a bit now versus almost never before.
Yeah. Okay. Are there any questions about that? Okay. And we kind of backtrack. There is one more thing that you guys can make buyers aware of as well. And this is something that not a lot of people know about. Honestly, I went through and bought 2 homes myself and I wasn't even aware that this was a thing that I could be looking for. But it's something that could kind of maybe make you sound even that much better as their agent. And one important thing to make your buyers aware of, as time goes on, and eventually they're probably going to sell their house again at some point, more than likely. And we need to let them know if you guys are making any improvements to that home, you need to be keeping records of that. All right. It's only going to help you later. It's not going to hurt you. So I'll kind of show you what that looks like. There's this IRS publication called Publication 523. And this one's actually specifically just for the sale of your home. So this is from the IRS's website. Pull it up. There it is. And it's pretty straightforward. This is selling your home. So there's a lot of good content here, but I'm specifically just going to look at what this part is. So if we scroll down to page 9, I'm going to try to zoom in a little bit in case you're having trouble seeing. So if you go through and make improvements to a property, well, what's an improvement? Just in general, what does improvement mean? Or to improve at something?
What about like
To make it better.
Yeah, to make it better, right? So are you staying the same? Well, no. An improvement is you're making the property better than it was. So you're not just going and fixing something and making the way it was before, right? So when you're thinking about is something an improvement, that's kind of where that gray line kind of comes into play, or the gray area. What is an improvement and what is just a repair or replacement of what was there? And that's where it's always better to ask or just go ahead and keep the record of it anyway. And then when tax season comes around, let your accountant know, hey, we did this to our home this year. Is that considered an improvement or is that just a repair of something?
What,
Okay.
so like, let's say if someone added like a half bath and like a butler's pantry and stuff, right? And let's say it was, I don't know, to that amount, and you got the bill and you paid for it, would you turn the invoice into your accountant?
So what I was leading up to that.
Okay.
So what you need to do is keep records of those invoices or
Okay.
receipts that you paid for that, because that is an addition,
Mhm.
right? And you keep that with the closing disclosure that you had originally bought the house with.
Oh, so
Okay,
you don't,
so when you turn around and sell it is when it becomes important.
oh, okay,
Not
not
that
like,
year you got it.
okay, not the year
So
that
don't
you
just be like,
actually did the improvement.
right,
Okay.
yeah. So I was getting to that point. I'm slow, so.
I was getting all excited.
But I know, some people do. But no, so like, for instance, I'll give you an example. Personally, like in our residence, what I've just got like a little safe that I keep all our closing disclosure stuff and all
And it's good
that fun
forever.
stuff. but,
Like, let's
yeah.
say if you live in your house 15 years and you've made improvements over the whole 15 years, you just say, when you sell your house, here's my receipts of the improvements.
You can, yes.
Even if you
So-
like replaced your roof twice or done X, Y, Z, you
Yeah.
still just kept them all.
I guess
Yeah.
because that, then your
Right.
taxable income or profit from the house goes down, right?
Correct.
Okay.
And then I'm gonna get to an example
Gotcha.
of what that would
Okay.
look like. Yeah. So here's some common things that could be considered an improvement. So like I was gonna say, like for us personally, I did some like significant landscaping, at least it was significant to me.
Right.
For our property. There was just like a patch of briars and poison ivy between my neighbor and I's properties, and I went through, I cleared it out. And it was a pretty significant area. And then I had to buy some landscaping mat. I even had to get some dirt to fill in some of the uneven places and some river rock. So all of those things that I purchased, I have now like kept together because that is an improvement to the property. It's now usable, where before it was not, right? Because that area is just covered in briars and brush.
So what's not considered, I guess? I don't know.
An improvement.
Now I'm like, okay.
Yeah. Yeah.
32 years, so.
I wish I had a lot more receipts than I
I
do.
know.
Of
So
course,
not
yeah.
everything counts.
Yeah.
Repairs where you're, and even painting where you're keeping it at the same level that you purchased the property at. If you have a water leak or you have something, even replacing the carpet with the same carpet. Now, if you upgrade the flooring, now anything that would add value
Okay,
to the home if you were to list it right for that.
but the IRS wouldn't be asking like, oh my gosh, show me pictures. You know what I mean?
Yeah.
Okay, okay, yeah.
So,
So I guess like if you take a like, what is it, the linoleum, or no, what is Formica countertops and put granite down, that would be considered an upgrade.
correct. Yeah. Mhm. Yeah. So, and again, this is directly from the IRS's website. So if you're probably to write anything down, like I personally have this page printed out and kept with my our original closing documents. So, and it's page 9 of publication 520.
We looking for some money over here.
Yeah. And that's
So
what we're
we got no,
looking
this apply to like, when you're trying to sell your house with a mortgage or without a mortgage as well? Like if you own the house.
But because if you,
Okay,
yeah,
you're
yeah,
gonna-
but, yeah.
Sorry.
So that, and which I was getting to the seller side. So this is primarily where it comes into play. So, so like we're saying, if you guys are working with sellers or you yourself are selling a property, what your accountant will need to have are the closing documents for that sale. And they'll also need to have the closing documents from when you bought it. Okay. What we're looking for and where the stuff we were just talking about comes into play is we're trying to find a basis. A basis is what you bought it for, what kind of improvements went into it, what other kind of costs went into it. Because ultimately, the IRS wants to know, what are you all in on this property? All right, and then what you turn around and sell it for. So that's where these capital improvements can really, they can really save you some money later on down the road. It's not going to help right now. It's going to be nice to have those upgrades and live in it. But we also want you to know, like, there is a benefit to it financially as well when it comes time to sell that property. Okay. So from the closing disclosure, when we sell it, again, you're going to see property taxes if those were paid by the seller. Any closing costs and commissions paid, those count towards the basis of that property when you turn around and sell it. Okay. And again, there's that page 9 from publication 523 on there. And what I can do too, I know some of y'all are writing notes. I've shared this with Melissa too, and I can make sure that she sends this out because these things are directly linked in here. You can just click right on it and it'll take you to those things. And then sometimes you might also see a 1099-S. That's the proceeds from real estate transactions. We don't see those that often. But it's one of those things, if you get it in the mail, it's basically just a summary of what's on your CD anyway. Okay. Now, has anyone heard of the primary residence exclusion?
If you've lived there 3, is it 3 out of the past 5? or
You're
2
so
out of the
close.
past 5, something?
Yeah. Yes, so let's
We
talk
need
about that.
chocolate for the,
We do, I should have brought candy. You
You're
get
just
something
making
from- There you
it.
go. Something from the goodie basket. So the primary residence exclusion, to summarize it here, this is I snipped this directly from the IRS's website, this picture here. What it means is if you have lived in your home as a primary residence, 2 of the past 5 years, you have a threshold of a capital gain that you can count. Okay, so if you are single, that means you have a $250,000 gain on your sale that you can be excluded from. if you were married filing joint, you can exclude up to 500,000.
They need to change that. That's been like that for, I know, at least 16 years.
And so, yeah, and what's nice about this is too, is it doesn't have to be 2 years in a row. So where it gets kind of iffy is if you're turning around and doing it every 2 years, then it's a problem. The IRS is they're not gonna like that. Yeah. So
Can you give me an example of that? I'm sorry, I hear about it all the time.
I'm
and I
so glad you
understand.
asked.
Thank you.
So we'll look at an example here. So this is one, let's say that this was your sale or this was your client's sale that they had this past August. This is actually a buddy of mine's. He cracks me up. I don't know how he got this price where he was, but anyway, so the couple that he bought it from, they originally purchased this property. You can see on the bottom here, just snipped it right off of Zillow. They bought it in 2017, turned around and sold it in 2022. So, and they lived in this house full time. So obviously they've lived in here over 2 years. Okay. So their original purchase price was $93,500. They sold it for 160,000. And let's just say combined the commissions they paid were 9,600. Now commissions can count into that basis we were talking about from what you originally bought it for. So it kind of helps to lessen that gap of how much that you could potentially pay in capital gains. So their actual gain on the sale was 56,900. So is that near the 500,000 or yeah, not even close, right? Even for a single person, they're well under that threshold, right? So that 56,900 is theirs free and clear. Okay, they don't owe anything on
So
that.
let's
That's
say
theirs.
he profited, let's say this house went crazy.
I'm getting there. I think.
Okay, you got, okay.
You're thinking.
You know, our brain-
Well, I was thinking about
And we're
you
doing
when I
their
did
married.
this.
Okay, they're
See,
married.
I was thinking about
Okay.
you when I made this point.
Okay.
So.
Let's do a more realistic
Okay,
example.
yes.
Yeah.
So all I did here was, as an example, I put a 0 on the end of it. So let's say that this
Okay.
property was purchased for 935,000. They turned around and sold it for 1.6 million, same time frame, right? Their gain is now over that $500,000 threshold, right? So there will be a capital gain tax that they have on this. All right, if this was a single person that sold it, they've got $319,000
They
that
ain't
they
gonna get
gain.
married.
Yeah.
Or
Which
single also
we've
filing
seen people
separately.
do that, yeah. So, yeah, so
Like
and
as
then,
an LLC or like a, what is that? An LLC?
Yeah, like an S corp or
Yeah.
something.
yeah, that's.
So if it's in the business, then it's gonna be taxed as a gain. This exclusions.
Oh, yeah, because you have to own it, like you
This
have
is
to live.
Oh,
in it.
oh, yeah,
Yeah,
right,
yeah,
yeah,
you have to-
yeah,
and it's your
yeah,
personal.
yeah.
For primary
Yeah,
residence, yeah,
sorry.
you have to live there, yep. And so, but let's say they worked with a really smart agent like you, and you were like, hey,
Get
did
married.
you remember to, yeah, first of all, get married, like Paul said. So it's a lot less. But let's say you had also worked with them before when they bought the house and you told them, hey, make sure you print out page 9, publication 523, and track those expenses that you guys, or those improvements that you put into your house. And they're like, oh yeah, we've done that because they're awesome. All right. And so let's say they went back through and like, here's what we came up with. Okay. And this is what I think when I first told Chris and Melissa that, you know, I would do this, I was like, I feel like this is something that not a lot of people know about. And this is where you guys, by being here or watching this later online or currently online, could like kind of set yourself apart. Be like, hey, just to let you know. And I think that's something that's going to be really valued from your clients. So let's say that these people went through and just as rough estimates, they did a complete kitchen renovation with modern appliances, 15 grand. I'm not going to insult you. You guys can read those other things up there that they improved their property on. And their actual gain was only 530,500. Well, without talking you through the exact math, they could potentially save thousands of dollars on that gain just by tracking those improvements that they've made throughout those 5 years that they lived there.
So what is the percentage, as you said, it's 20, your tax at 20%, the capital gain rate over the $500,000, anything?
That's the
over-
maximum one.
Oh,
I'll
so-
show you the tables in a second.
So
Yeah.
it should never go over 20%.
Right, that's
If
the
it's
highest
your
long term.
primary, okay, that's
Yeah.
all.
That's the highest for a long-term gain, because obviously that would apply here. These
When it's
people
long-
live
when
there,
They've lived there longer.
Right.
Yeah,
correct?
longer.
Yeah, so, but in the grand scheme of things, especially if you're looking at the married filing joint, I mean, to me, that went down half, $69,000 just by tracking it over a few years. Their gain was really only 30,500. Okay, so big win. And so what this would look like on the actual tax form, this is Form 8949. Your actual basis that you have put into that property is over $1 million. So you can see here was their original purchase price. There was the commissions they paid. Here were those 4 improvements that they put into their home. Okay, so on the tax form, this is what it looked like when they bought it, when they sold it. Here's what they sold it for. Here's how much they put into it altogether. And this is just the code that says, here's the primary residence exclusion. As a married filing joint, they get that $500,000 exclusion there. So really their only taxable gain is $30,500,
So
which is nice.
if your roof was newer, but your insurance company paid for it, that doesn't count, right? You technically did not pay for that, except for your deductible.
It'd be out of pocket, your cost out of pocket.
I figured, but you know.
Sure.
Never hurts that.
And I've had my house over 20 years. I know I don't have receipts for big things at this point, and
Yeah.
it has to be invoiced and recorded. Is that no estimate of,
Yeah, or
I know it was 10,000 for the porch, or,
yeah. Or I think we've even seen like bank statements where it's cleared,
Mhm.
like the payments, because those will sometimes even have who you paid it to.
Mhm.
So, but again, you gotta reach back sometimes for those.
You have to get
So-
your receipt, the checkbook, where you wrote the check. and you
Yeah.
know.
There you go.
Give
Or
me
if
an
you're a
old
paper
register or
order, it
something,
might
yes,
still be a
yes.
box.
Yeah, so just in summary, working with your clients, again, here's some things that you can advise your buyers on, that they need to give their accountant or have prepared if they file it themselves. This is what you need to have when it comes tax season. So they need to have that closing disclosure, have that mortgage statement ready. Any taxes that you paid, either receipt or the bill, those will work, or you can even just pull it straight off of the county's website where you paid it. Sometimes we'll just look that up too. With your sellers, again, make sure they've got the closing disclosure, both of them, from when they bought it and when they sold it. And then, of course, that publication 523 page 9 would be a great help to have too, if they had any of those improvements. All right. And then any invoices and receipts. Now, I will kind of say from our side, it's not always the best just to get an envelope full of receipts and invoices. If it probably doesn't take much time out of your guys' hand or the client's hand to maybe put it on like an Excel and just kind of summarize it, instead of having us trying to rifle through and see. So like here was all my landscaping improvements. So I would maybe in an Excel put like, here's the landscaping mat, here was the landscaping nails, here's the rocks I paid, summary total, boom, here's a total of what I paid for this
And then just
improvement.
attach the receipt,
Right.
safety
Yeah.
behind it or something.
Right, because we're not gonna need to send that to the IRS. What we're doing is we're trusting that what you guys are giving us is gonna be correct. And we're gonna put it on there, so that way, in the event that you are audited, you have the proof to back it up, right? So on our end, that's always easier if we get a summary of what it was. Plus, it's gonna cost you less more times than not, because your accountant won't have to rifle through it for as long, so. Okay, but are there any questions about working with buyers, sellers, tax advice you could give them? Or anybody online?
We always have to consult your
Mhm.
When in doubt, that's right. Okay. I'm gonna let Dan talk about this one.
Mm.
Okay, so rentals, and I completely agree. There's a lot here. So I'm gonna keep it pretty high level. And then if you guys have specific questions or even want to email us after, and I should have probably said this at the beginning, we're here, obviously, right here close by. And we pride ourselves at Potter and Company at being accessible, even if you're not a client. I mean, if you need advice and tax planning over and over and over, then we'll eventually talk about maybe signing you up as a client. But we really do like helping our community, and that's a big thing that we do at Potter. So if you think of something later on and need to shoot us a quick question, we'd be glad to respond to that outside this meeting. So rentals really come down to two categories. Short term, meaning 7 days or less. And that's really, think about hotels, and now, of course, Airbnb and VRBO or Verbo. The rules were written years and years ago, and they really sort of want to differentiate like a hotel rental versus long-term, monthly, long-term rentals. And so that's really two reasons they wanted to differentiate that, is so you can aggregate. So if you have 4 Airbnb properties and one long-term rental house that has someone that's rented it for 5 years and then been there the entire time, those are sort of going to be treated as two separate activities. And so for aggregation, for taxes, we can aggregate those Airbnb or hotel or Verbos and treat those as one activity. And really where the sort of the bottom line of why it matters is if you have losses. The IRS is more than happy if you make a profit and they're going to tax you on your profit. But if you have losses, then there's very specific rules, again, for rentals at all, because generally it's a passive type of income, but there are some sort of exceptions so that you can count some of the loss or even possibly all of the loss. And that's where you kind of get into the weeds. So I'd probably either we'll go through questions, we'll go through a couple of examples, but that's probably where you need to talk to your accountant or us or whoever, because it can get really specific as you get down into the specific rules. So if you'll jump over to the next page. So staying at the high level for just a second, this is sort of the form that the rental gets, no matter what rental. It could be commercial rental, it could be your home off, your personal office that you rent back to your own company, or Verbos, Airbnbs. So it all goes on this form. And the reason we wanted to show you is because I think one of the first questions we get, and you guys might get, is what can we deduct for our rentals? And so that really gives you the expenses there. The number 6, the auto and travel, that's a big one. Definitely want to track mileage, especially if beach properties or wherever, even in town, that can add up. And you want to track that. Obviously there's apps now, there's journals. You can, the IRS does say that it needs to be documented, but that could be electronic. It could be an app. I know there's lots of things out there that help with that. And then, so let's see, a couple other things. So there's a couple of funny rules with rentals. If you have, every now and then you might get a question about, I rent my house 2 times a year for the race, the Charlotte races. And we've actually had a client. And so if you rent a property for 14 days or less, it's actually de minimis. The IRS doesn't want you to report it, income or expenses. It's just a non-reportable transaction. So that's one thing that gets excluded from rental activity. And then the other thing is, which we've circled there towards the top. So if you have a beach property or even something here close by, personal use days. So you are asked to track how many personal use days, for example, a beach property. One good thing to know that days that you're there to work on the property, to repairs and maintenance type work, those, like if you do it yourself or you're there overseeing the contractors or checking in, those aren't counted. It's truly like personal use for vacation. And includes family and friends that use the property if they're not paying fair market rent. I know that's sometimes a question we get is, well, we, let our friends go and we just don't charge them anything. Well, that technically counts as part of your personal use stays. And the reason the personal use stays are important is it will end up prorating. So if you're using the beach house 30 days a year and you rent it for the rest of the year, then we just have to prorate the expenses. So you still count the income, you get a little bit less of the expenses counted towards the bottom line of the rental activity, but that's just something to sort of be aware of. And then if we, again, there are ways, if you have losses, there are a couple ways that you can get to count those. If you have a loss on a property, first of all, they want you to put that together with any other passive income. So if you have other types of passive income, they're going to aggregate that. But if you have a net loss, there are a couple ways. If you're considered an active participant in that property, so not a triple net lease where all you do is get the check and other people take care of everything else with the property, but you're actually there checking on the maintenance, going and picking up the check, doing the accounting, then you might could get to a level that the IRS says, okay, you're actively involved, so we're going to let you count part of the loss. And then there's even another step if you're called a real estate professional, which some of you in this group could get to that level. And that's also a step in the sort of the rental analysis. If you have several properties, you're sort of overseeing a lot of the activity related to those properties, then you could be considered a real estate professional. And that's one of those tests is 750 hours of service. So you do sort of this activity as part of your, that's 750 hours a year. That's a lot. And then you can sort of get some tax preference treatment as in regards to the rental. So that's more of a case of like multiple rental properties, a lot going on. So that's rentals, and so, yeah, so a couple other little things to know. Obviously with rentals, you do get depreciation. So on that purchase price plus your improvements, you're going to get to depreciate as one of your expenses, some of the costs associated with that, even your furnishings. If you buy a new TV or, any sort of redo the pool or whatever type of expenses you have. And then also you can take some personal expenses if it's used exclusively or partially for the rental activity. That's something that your accountant will hopefully ask, what else are you using towards this rental activity? And then the IRS did pass a rule fairly recently that said, okay, anything under $2,500, we don't really want you to track that and list those separately and depreciate them. So like laptops and couches and small things, we're just going to let you count that as a de minimis expense item that no longer has to be depreciated and listed separately. And then let's see, one other big thing with rental activity, and just to highlight, I think you guys know there's a thing called a like-kind exchange. It's a 1031 like-kind. It's a tax deferral exchange. And so a lot of times you'll have a rental property that you'll sell. And if you follow some very specific rules, then you can defer whatever gain would be recognized if you roll that property into another rental activity. And so that's very popular when, people are shuffling their rental portfolios around. If they follow the rules, and we would say definitely talk to your accountant, but then you actually are required to use something called a qualified intermediary. It's an attorney So you never see the funds. They go through the attorney and then those funds roll into the next property. If you do cash out, like you do a partial cash out, you're gonna pay partial tax, but some of it still would be deferred.
How long is that deferred? So let's say if you sold a rental property and you show a profit of 200,000, right? And you bought another property for 400,000, so you did, because I know you're supposed to go up, right? So that 200,000 that you would have potentially had taxable gain is deferred. So how long is it deferred? So like if you take this other house and you have it for 5 years and you sell it, are you gonna have to pay now capital gains of current and the 200,000?
Yeah, so it's gonna go
hit.
back to that original basis plus the additional basis if you did go up.
Yeah.
But yeah, the deferral can be infinite. So you can
Until you
roll,
sell it.
and in that second sale, if you roll it again to another property for the full amount of that property, then you can defer it yet again. So there's really not an end point until you cash out.
Or
die.
die.
Or die.
And actually, yeah, whenever it's inherited, that's the last step here. When,
Yeah.
you know, when you pass away, whoever inherits that property, it now steps up to a new basis of whatever the value of that property is at that point of death, and they inherit it.
And so they
So
would
it
have to.
completely
But they don't-
eliminates those
Oh.
gains that you've had throughout the years.
Hmm.
Yeah. So if you want to keep your kids from paying taxes on all those gains that you're making by deferring it, just hold on to it. They'll appreciate that.
Yeah, the
Understand.
1030, the like kind is it's popular. It's a buzzword. I know you guys probably
Mhm.
get questions on that. And just the bottom line with that is just there's very specific rules and there's a couple groups in Charlotte. We don't do 1031s. So we send them to, there's folks here in town that probably specialize in it too. But
Don't you have 45 days to reinvest?
So, yeah, there are some very specific timing and to be honest, I always have to look that up. You have to identify the new property within a certain time frame, and then you do have, even though the funds are sitting with the attorney or qualified intermediary, you do have a certain amount of time to actually reinvest.
I think that's what Paula was asking.
Yeah, and I think, isn't it Laura? Doesn't she do a class here every so often with the 1031? Laura
Oh,
Huckabee, is that her name? Yeah,
Yeah.
I think I've seen her name come up. So I know, yeah,
Yes.
we've got some recordings of her. She's been outstanding. I've seen her
Yeah.
class before.
Yep.
So,
Yeah, that's a little bit of a specialty. But again, yeah, definitely shoot us questions or we can look up some specific rules if you have specific questions.
question.
And so, yeah, anything on rental, before we jump to capital gains for just a second, any other questions from the group about rental activity?
I think that was,
Those might be old.
yeah, I think,
Yeah.
yeah, just internal
Because
chats.
it maybe. that's why I changed mine,
Oh, yeah.
because that was-
And so it's a good time just to talk about capital gains, which we've talked a little bit about the exclusion for your primary house, but for other property, investment property like rental property, vacant lots, anything that's sort of investment type property, it's a good idea to just refresh the general rule on capital gains. It's the short term versus long term. You really want, if you can, to get the long term treatment, which is exactly a year or longer. The short term rates are essentially your ordinary tax rates. So your personal income tax rate, if that's 22% or 28, 32% or 37, as high as 37%, that short term capital gain will be taxed at your personal tax rate versus long term. And those rates are preferred. You see there There's even a small bucket that is at 0%. There's a pretty nice bucket there in the middle for 15%. And then 20% is the max. So even if your total income, including the capital gains, are over that amount. And so you, of course, see there a small difference in timing could lead to a 17%. And do you want to mention our odd example?
Oh, yeah, we actually had a client come this year to us. Well, potentially, it was a new client. They didn't like our answer, but but when it comes to a short and a long-term gain, there's a very specific cutoff of a short term is 1 year or less. A long-term gain is when you hold that property over a year. Unfortunately, this person was given bad advice. He had bought his property on August 16th, 2021, and closed on August 16th, 2022. Unfortunately, we tried to find, maybe it was submitted to the county a day later, but there was nothing that we could find that did that. So it ended up being a $16,000 difference in their gain that they had to pay in addition to the taxes they already owed, just for being off by 1 day. So, so does it matter?
So was it because he held it longer than a year, basically?
No, he
or-
held it for exactly 1 year, which is considered a short-term
So you have
gain.
to go over.
So you have to be
1 day.
more than 1 year in order to be a long-term gain. So
So
and
he would have just said August the 17th.
he'd have been fine. Yeah, he would have saved $16,000.
Wow.
So
Now, that's the date of, if you go from the date that the deed was actually transferred to his name and the deed was transferred out of his name, right?
correct.
Oh, my
Yeah.
God.
So
I wouldn't believe it.
so yeah, so he wasn't too happy. And he went to seek services elsewhere. But anyways, it can matter. So, and it's funny because Melissa had actually emailed me last week about this. She was like, hey, I've got some clients looking at selling the property. What's it going to look like? And it sounds like they're going to be well beyond the 1 year. But I was like, hey, just make sure that this is going to happen because it could be pretty significant to some people, especially with the type of gains that we've had in the recent years. It can mean a lot to some people.
Quick question there. Let's say you buy a piece of property for $200,000. You split the property up in 4 months. You sell part of it for $25,000. You don't have to start paying capital gains until you sell enough to beat the original purchase price.
No, so you would allocate, if you divided it into equal 4 parts, for this example, you would allocate a fourth of your original cost to each new property. Now, are you talking about an actual like subdivision property?
Yeah, how'd you know?
Yeah, so there is a specific exception where you can delay some of the costs. Now, I'd have to look at that because I haven't actually had one of those in a while. But in the case of subdivision, there is a specific rule about how to sort of allocate those costs, and that might be where you were headed with that question.
Is that a question for you guys or my accountant?
Either. I know we've had an example of that recently in one of our other offices, so that'd be a quick check-in email if you want to shoot me an email. And then, of course, yeah, you definitely want to talk to your accountant about it.
Thank you.
Any other questions about capital gains?
Is the depreciation recapture?
So
Yeah,
you wouldn't even
so when you sell a property, you're like a rental property, you've depreciated, say it was a condo, and you've depreciated 20,000 of that original cost because you've owned it for 10 years. There is a thing, depreciation recapture is part of that gain associated with the dollars that you've taken in depreciation will be taxed at a little bit of a higher rate. There's some other sort of factors, so it's not an exact number, but depreciation, because part of your cost basis, you took out as an expense at a higher deduction rate, like tax rate as an expense, the IRS is, okay, that bucket is going to be taxed at a little bit higher rate. Some of it's 25%. So you're right. There is a second piece of the calculation for some of the depreciation you've taken. Yeah.
Yeah, and some of it could kind of add up too, especially when we're still in a pretty good chunk of the bonus depreciation this year. So last year you could get 100% bonus depreciation for some of those capital expenses that were maybe like 15 years or less that you had to a property. So like if you had a rental and you bought, you know, a $10,000 couch, you could bonus that entire 10,000 last year for 100% of that. Now, if you turned around and sold that property this year, well, that's going to 10,000 going to catch up real quick because you went ahead and bonused it. So that recapture is going to come back. But this year it's still 80% bonus depreciations you can take. Then the remaining 20% will go over the useful life of that. So that's a good question. So just to kind of summarize some important things that you guys can tell your real estate clients. Again, copies of closing disclosures, keep those invoices or receipts for any of the capital improvements. Y'all remember the publication number, page number?
523, page
Thank
9.
you.
Yeah, page 9, 523. That's right. And then remember the 5-year rule. And then be aware of those short-term, long-term gains. You know, again, if it looks like they're close to selling it near the 1-year mark, if it really doesn't hurt them, if they're not going to get any extra holding costs for holding that property, maybe just a little bit longer to meet that 1-year threshold, it could pay off for them. Sometimes it's not always the best to do that. Some people know that they've got a deadline, they need to turn around that money into something else. So it really depends on a specific situation. And when that's the case, you guys already know the answer. Tell them to ask their accountant. So, but again, make sure you guys are tracking expenses, income, keeping those invoices and receipts. And again, if you can, when it comes to tax season, summarize that onto something and give that to your accountant. If they want more details beyond that, then you've already got it to give them. But for the sake of their time and for the sake of your time and your wallet to spend them looking at it, you probably just want to give them that summary. Okay. But when in doubt, ask. So now that we've rambled enough about your clients, let's talk about you. Are we over?
Well, like, I don't want to make you stop. I don't want to move it any longer.
Do a pause.
So we can, that's what I was gonna say. Do you
That's fine.
have time to
Yeah, we can pause.
pause? Do you,
You probably have about, what, 10, 15 minutes left?
Yeah.
Yeah.
okay,
Unless there's extra
So-
questions.
if we wanted. Positive.
Okay. Sorry, we got lunch here in the office, so it sounds like we're gonna.
I have the right. I did it. There we go. You're it, Zach.
Well, thank you. First of all, I want to say thank you all for just letting us come and speak. We would like to be looked at as like a resource and sort of to explain why and what we're doing. This area on June 26th was hit with a catastrophe hailstorm. Some of y'all saw it, some of y'all remember it. It was from Concord Mills all the way up to Winston-Salem. And so y'all probably ask, well, what does this got to do with us? Well, we all know that when you're working with sellers, when the home inspector comes out, one of the first things that they ding is the roof. Curled shingles, missing shingles, age. So what we wanted to get out was that for the next 6 months, the insurance will pretty much buy any roof that is older than 10 years old if it has hail damage. This area got 1-inch hail from, like I said, Concord Mills to Winston-Salem. So what we do is when we do have a realtor call us, we go out, do a free inspection, see if it has storm damage. If it has storm damage, we can then help alleviate that possibility of a buyer coming in and saying, hey, you wanted $400,000 for this home. It needs a new roof. I'll give you $385,000. And so we do actually work with a couple different realtors, some individuals, some companies. The process is very clear cut. We're not the boss in this, the insurance is. But because of the size of that hailstorm, any roof older than 10 years old starts to get a little brittle. And when those little stones come in, it leaves divots in the roof that will eventually leak. That is why they paid to replace it. I know as a realtor, you need everything done yesterday, and we understand that. The whole process from start to finish is anywhere from 21 to 28 days. The roof build itself only takes 1 day. We show up at 7 a.m., we finish at 7 p.m. that night. We work with some companies where, you know, the seller gets the home approved, and then the prospective buyer picks the color. The money goes into escrow. So we're familiar with that process. We are very patient. Sometimes mortgage companies get involved, but we always know that your customer is the most important thing to you. It's also the most important thing to us. Your customer service is really where we try to rise up above most general contractors. And so know that we try to stay ahead of communication. We do the evaluations for free. We want to be a resource to you guys, because I know everyone in here within the next 2 weeks, you're going to be going to sell a home, and the home inspector is going to come out and go, oh, this roof's old. That's what we want to look at, is your old roofs. You know, this will save I'll also tell you this will not cost the homeowner 1 penny. So I hate to say the word free, because normally when people think free, they think scam. This isn't right. No, the insurance is the boss. We are a volume roofing company, so we're able to absorb the deductible, their copay, into the cost. So it won't cost them anything to get this roof replaced. When we do a roof, we cut out and replace any wood rot, and we install a 30-year architectural. Some of y'all might know what that is, some of you might not. That's okay. You're realtors, not roofers. But what that means is we install a good product on the roof. And so whatever's up there, they will have a better roof when we're done. The only information we need, if one of y'all were to do it, is have a report come back today, I just need their address and who their insurance provider is. The reason I need to know the insurance is they all have different criteria that they adhere to. Some insurance companies need 1 broken shingle on that roof to replace the whole roof. I know that might sound crazy. Again, they're the boss. We're just sort of help people navigate it. The average is 10 or 15. And so once we know who the insurance is, we can then do a proper evaluation for you, take pictures, write you up a letter. Another service we provide is sometimes when the home inspectors come out, they'll look at the roof and go, oh, this is wrong, and it's not wrong. You know, that we all know that home inspectors are very thorough. Sometimes they put a lot of stuff in that report. Maybe it should be in there, maybe it shouldn't be. But we will help you with that. We can provide what's called a good to go letter, which means we can come out to the home, inspect the roof, and it'll say this roof was inspected on this date, and we found these issues to not actually be an issue. This roof is good to go, and we give you a baseline. This roof should last, 1 year, 10 years. And then you have an idea of something that you could sort of, go back to the seller with, hey, look, or the buyer, the home has been inspected. I'm a licensed general contractor, so we're not just out here blowing smoke. I tell people whenever I do this, we basically are working not with the insurance, but basically with them. They're the boss, but we just help you get through the process. Most homeowners do not even know they have an option to get their roof paid for. I would say 80 to 90% of our customers call us out because they have a leak. I go look at the roof. I'm like, hey, look, you got a leak. You can fix that for $500, or I can get you a whole roof for no out-of-pocket cost. We go through this on a daily basis. Each year, we replace around 500 to 700 roofs. Our home office is here in Kannapolis, but we work all the way up to Raleigh and up to Boone. It's like a big triangle. We get down to Ballantyne as well. And so we'll pretty much go anywhere within North Carolina. We'd rather not be in South Carolina, but I don't think a lot of us are probably selling in South Carolina. And that's just a licensing thing. But with this, it is a very streamlined process. Everything is documented. We put together a report for you, has all of our license information. We can send it over to you as far as if the roof is good or if the roof is bad. An inspection normally takes 10 or 15 minutes. No one has to be home. Everything we do is on the roof. It's always tell people you're not obligated to be there because unless you want to get on that roof with us, we're pretty much self-sufficient. So the basics of what we are saying is any roofs on homes that you are selling, if you have any problems, call us. We'll come out, look at it. If we can help through the process, we will. If we can't, we're going to tell you that too, because the insurance comes behind us. If we do an inspection on the property and we say, oh, wow, this roof has hail damage, let's call the insurance. First thing the insurance is going to do is they're going to be at that house normally within 72 hours of when the homeowner calls. We meet the insurance there, point everything out to them, and then they say yes or no right there on the spot. It's a very simple process. Again, it is more of a niche. Most people don't even know that you have an option, but it is a calculated business decision when you get the insurance out. When we're talking the average roof nowadays, $12,000 to $15,000. That's a lot of money. And if we can save that money, it's going to make your seller happy and it's going to make your buyer happy too, because you're going to have a brand new roof. The warranty goes with the new homeowner. So if we replace it and then the home sells in 6 months or whatever, they do still get an extended warranty for 3 years on that roof. They are fully covered on the exterior and the interior. So if there's a leak, we take care of it. Now, granted, when we do these roofs, we do multiple upgrades to try to ensure that we don't have problems on this project. The main thing, again, I'm just going to stress on it. We just want to look at any roof older than 10 years old that gets dinged by the home inspector's report. And if any of y'all live in the Kannapolis, Concord, China Grove, Salisbury area, it might be a good idea to get your roof inspected as well. The inspection is free. Again, everything is very well documented, and then we can tell you whether or not you need to pursue it. But more importantly, we can give you a baseline of where you are on that roof now. And so we'll tell you, hey, look, you need a new roof now, or maybe in the next 2 to 3 years. We don't ever try to push a roof too early. With roofs, it's not really a matter of if you're going to need a new roof, it's when. And with us being a local business, we've been in business almost 2 decades here. We are established, and if we end up working for someone now, which immediate gratification is great, doesn't always work like that. Sometimes we work for our customers 2 and 3 years down the road because maybe all they needed was a repair. And so we just want to become maybe a resource that y'all can utilize with any problems y'all have above the roof line. And again, I'm not going to keep y'all. That is all I really wanted to say. Is there any questions I can maybe answer for anyone?
Do you have your business card?
Yes, ma'am. We got a
Oh, okay.
bunch we're going to hand out. And we are on the BBB. If you check out our reviews, again, we are a 5-star business. I own the business, and so I do all the evaluations to see if it's worthwhile. I also have the relationships with all the insurance companies, Nationwide, State Farm, Allstate, because each insurance company has the same adjusters in that area. They don't really rotate too much. And so if we think a roof should get replaced, it's normally like 95% they are going to replace that roof. They're going to agree with us because everything is very well documented through the process.
What would you say for investors, who are some of our clients that have multiple properties? Does the insurance claim follow the property or the person?
So
Like, I don't think State Farm's gonna be thrilled if you put 8 or 10 or 15 claims in one calendar year.
I'll
Is
give
there
you
a
an example.
strategy?
Bobby Whitley car washes around here. He owns 50 rental properties. Over the last 3 years, we've replaced 6 to 7 roofs every year when the hailstorms come in. This is also not a personal claim. This falls under a catastrophe. This is date specific. And so about 5 years ago, we ran 62 roofs for Dale Earnhardt Jr. He was with Nationwide. He ran every single roof he had in Mooresville, and they bought like 55 of them. Never had a problem with his insurance. His insurance doesn't even go up. To explain how this works with insurance, because a lot of people ask that, like, hey, well, what if I were to file multiple claims? So this is actually done off of zip code. A lot of people are worried, oh, I file a claim, my rates are going to go up. Well, here's how that works. It's all based off of, let's just say 28081 zip code. If State Farm has 500 policyholders in that zip code and there's a hailstorm and 250 people file a claim, everybody's going up. Doesn't matter if you file a claim or not. If in that zip code 28081, let's say State Farm has 500 policies and only 50 people file, nobody's rates go up. So it is not an individual aspect when you're looking at this as far as, like I said, I have some people who have filed multiple, dozens of claims and never had an issue. I've also had a doctor one time, his wife lost her $32,000 ring. They filed a claim on it. They filed a claim on the roof a week later, they dropped them. It's not always, black and white. Unfortunately, the insurance is very gray, but the basic is it is off of the zip code. And so when you do have an investor, and again, we would check them all first, and then we give them a report on all of them, and then we give them a baseline. We could be like, hey, this was one you need on your radar. These are 3 or 4, maybe you should look at in 4 or 5 years. And it just gives people a good idea, because I will tell you this, I'm not here to fight with the insurance. I'm not here to have a disagreement with them. We make this where it's very clear cut. If there's storm damage up there, we get the insurance involved. They will gladly help. If there's not storm damage and I can't photograph it, I'm not going to encourage the homeowner to, it might just be an old roof. Sometimes they got to buy it. And, I prefer to get the insurance to purchase it, because obviously that makes it a lot easier on everyone involved. But if it is just an old roof, we can tell them that too. Hey, look, your roof is old. You might want to consider this in the next 1 to 3 years. With customers, we can help service them along the way if they've got some small issues. And so, to answer that question, no, it's not, it's not individually looked at. And now, don't get me wrong, they're not happy when anyone files 8 or 10 claims, but this is business. I always tell people, you have a policy, and it's called almost every person that has a mortgage has what's called a replacement cost policy. That means that they will pay for sudden and immediate damage, not maintenance, sudden damage, which is what hail causes. And so we do work well with a lot of investors, because again, when they have multiple properties, they're eyeballing those bills in the pipeline. When you look at a roof and you're like, man, I'm gonna need a roof in 2 to 3 years. The average roof on a 1,500 square foot home is 10 grand. That is a lot of money. Everything has gone up, unfortunately, since COVID, almost double, and it has not come back down. And so we just tell people, utilize us as a resource, and we can definitely save you some money along the way.
Thank you.
Yes, ma'am.
Now, would you guys let's say if we're gonna list a house and it's kind of older, could we call during our listing presentation, recommend, hey, we partner up with our brothers, and I would would it be okay if I let
Yes.
them come out and look before we even get the thing on the market? Because I have a feeling your roof is gonna come up on the home inspection.
Yes. And that is actually, the sooner you do it, the better, because it is a 21 to 28 day process.
Yeah.
But yes, if you were to go out to a home today and you're like, oh, love the home, maybe you need to get that roof looked at, you can call us up. We'll get out there and check. We're normally within 48 to 72 hours. Like, you call us, it goes on the schedule, and then I come out and do the inspection, either myself or Preston. And yes, please utilize us for that.
But then at that point, it wouldn't hold up getting the house on the market. And if we know it was approved, we could advertise home is getting a new roof.
Yes, ma'am. And a lot of whenever we do this process, a lot of the times the buyer is the one picking the new color. We have that, don't get me wrong, the current homeowner owns it, they put whatever color they want on it. But a lot of times they use that sort of as a little hook, hey, if you buy the home, we got it's already paid for, you pick the new color. And so, yes, please do.
It's like an investment property, like Thomas Paul is saying, like if you want to, I get an investor like, okay, I want to sell my house in 2 weeks, I want it on the market. Will the insurance still be like, okay, well, now you're under
100%.
contract, you can't.
They don't even care if it's for sale. No,
Okay, gotcha.
So again, to go back to the legal side of it, when you are in a policy with an insurance company, until that property is out of your name, the homeowner has full coverage. And so you can have, we have real estate signs in the yard when we're meeting the adjuster. And the adjuster's like, well, I guess this new homeowner is about to get a new roof. And, they're sort of joking about it because this is a system. We only work within the insurance's parameters. Again, they will not buy roofs just because they're old. They will only buy them if they have hail damage, which is consistent with either hail or missing shingles, which is considered wind damage. And so, again, the evaluation will determine that. But no, as far as if you're selling the home, has no bearing on it at all. As long as the current homeowner is up to date on their policy, then they have full coverage on it.
Thank you.
Yes, ma'am. Thank you for the question. Anything else before I let y'all go back to your day? Awesome. Well, guys, thank y'all so much. Please eat. Hey, I brought extra food. Take some home with you.
Take some of that back with you.
Oh, trust me, I'll go grab at least one chicken sandwich.
You can take a whole tray back here.
No, we want you guys.
Thank you, guys.
You want to just put some bit in vegetables for cards or
Yeah.
something, or-
Thanks for sharing
In
the
the foyer, you'll
PowerPoint.
see a table with,
Use some business cards. We're just gonna put some business cards up front, again, I stress this to anyone that lives in the area, if your roof is older than 10 years, please get it looked at. Whether you get it looked at by me or not, you are a very prime candidate to have your roof replaced. Preston is actually your rep on this, but again, I'll do all the inspections, but we're gonna leave some cards up front. And thank you guys for your time.
Thank you.
Yeah.
Appreciate it.
Nice to meet you.
Yeah, nice to meet you.
Good to see you, Connie.
All right, everybody out there. Go back over to Chad again.
It's good to see you. Nice to meet you. I already had some, ate a chicken sandwich.
guys, food, can we give you food?
Yeah,
I'm
can
good
y'all
right now.
Please eat some.
Oh,
You
Here's a
see
lot
how
of
much
food.
food you brought?
I'll probably take a to-go cup.
Eat.
I'm gonna take another sandwich.
Hey.
Live and recording, so
Awesome.
go back whenever.
Said, oh, going from the exciting stuff back to taxes. It's not as sexy. That's okay. All right. So let's kind of wrap up here with talking about how maybe you guys can benefit as far as running your businesses, what things that you should look for when it comes to tax season, or just things that we're doing throughout the year, just to kind of make that more of a seamless process when tax season does come around. So obviously, typically income is coming through your guys' 1099 issued by Lantern or wherever else that you're also doing stuff with, and then also cash, which I thought was a tough crowd. That's okay. Right. But technically those things are all accounted for as far as your income, if it's in regards to the business that you guys are operating as real estate agents. So but the main thing, which I'm sure you guys are aware of what income would look like, the main thing is, what can I put as an expense towards my business, right? Because ultimately that's what's going to make my income look less when tax season comes around, because I don't think that tax season is a really favorable time for real estate agents, mainly because you're getting a 1099 and not a typical W-2, where it, it's not as much of a hindrance, I guess you could say, when that time comes around. So looking at on the Schedule C. So this is where personal business stuff would go on a Schedule C. So all your profit and loss or P&L you may have heard of, this is where all that information comes from. So we look at, again, your income is going to be up top, and then all those expenses that you guys can count towards your guys' business. And I'll pull up an example too that I've made. And that's something that I can share with Melissa too. And you guys can just use it and manipulate it however you want for your own benefit. But there's not a lot going on with this form in regards to probably what you guys want to know. But I'll show you the example. Actually, that's not going to come up on there. So what I've done is kind of screenshotted just the expenses part of the Schedule C. And if this is super small, I can try to zoom in a little bit. The main thing you guys are going to look at are what can I expense? And you can see those categories here, like advertising, car and truck expenses, which we'll talk about a little bit separate here in a minute. Commissions, fees, and again, these are all things that you guys pay out of pocket towards the function of your business, right? So even office expenses. So if you're paying rent for an office space somewhere, or even indirectly through your own home, if you have a home office, you can use a business use of home where you get a certain percentage of those costs basically deducted away from your income on your Schedule C. Any taxes, repairs and whatnot. So what I've done is kind of put like a little summary page together here. And then the detail is more here. So like, here's what it might look like for you when you're going through and purchasing things for your business throughout the year. So as it happens, rather than, again, like I said earlier, it's not always fun to get an envelope full of receipts and invoices. Just summarize it on a quick little Excel document like this, print it out or forward it to your accountant. It makes it super seamless for them or for us, okay? And all I've done here is just gone through like, hey, here's the date that I purchased this. Here's the category that it falls under. And if you're not sure, just kind of look through and be like, all right, which one does this apply to? All right, in regards to that. And that's all I've done is just basically taken the ones that I know I use or I'm probably going to use, and I just stick it over here and just kind of add it up as I go throughout the year. Then you'll see, and it's pretty straightforward. If you even just click on the cells, all I've done is added the ones from the other page. But are there any questions about that?
You said, did you say you were going to give us a sample copy?
Yeah, I actually forwarded it to you already.
I will.
So,
Pull that out of my
but yeah,
phone.
so would y'all find that useful?
Oh,
Yes,
yeah.
okay. So, and again, you can manipulate it however you want. So mileage is one thing, and we'll get to that in a second too. So hold on. Did you have something to add to that? You like you want
Not
to
till we
say?
get to the mileage.
Okay, fair enough. Business use of home is another thing. I'm just gonna go ahead. Does anybody use that? Just out of curiosity?
Use what?
Business use of home. Do y'all know what that is?
Oh, yeah, I do.
I don't.
I do.
You use an office space in your house.
That was the other question. What if you have the? Can you do this? Yeah.
Yes, you can. If
And-
it's,
He didn't tell me.
Yeah.
I even turn in like my power bill, my phone, like
Mhm.
anything, and he takes a certain percentage of that.
correct. That's what I was trying to pull up
But
here.
I have a question about that. Since I am basically using my home, part of my home as business, and I'm getting credit for it, right?
Mhm.
When you go to sell your house and they say, have you conducted business from your personal home within the past 2 of 5 years, or I think that's how it's. They're gonna ding us on that, aren't they?
Only if you set up, it goes back to that depreciation recapture question earlier. Most people, when we do a home office, we do the utilities, a little bit of the taxes, a little bit of the mortgage interest, but we don't generally
Depreciate.
use the house, cost of the house, because if you
Because
do,
then
then it
it's gonna
will,
ding you.
yeah,
Right.
it
It's not an
will,
Yeah.
improvement.
Yeah,
yeah.
So
Right.
let's say you are doing that, depreciating some things, because you got another business on the property, right?
Mhm.
If you stop doing that for 2 years,
Mhm.
2 years, and then sell 2 years, as soon as it's a little over 2 years old, then you can answer no to every single one of those questions, right? And not get dinged for,
That I'd probably need to look at.
you know what I'm
That's,
saying though, right?
yeah, because a lot of the verbiage is 2 out of the 5 years. It sort of is a grace rule, but I would probably want to double check that if you did depreciate it earlier. I'm not sure if that depreciation hangs on. We'd have to look, because we don't really, we've years ago decided we don't want that to trip up when you have the tax-free
Yeah.
sale of your home. So none of our clients depreciate their home office. Yeah.
Mhm. Yeah, but you're right, you're on the right track saying, basically what you're doing is you're looking at, well, what's the square footage that I actually use? So do you have a dedicated space, whether it is a separate office in your home, or if it's just a small section of your bedroom or dining room where you have a desk, like measure that out. So what we put on here is the square footage of that, and then the square footage of your home. And what it does is it takes a percentage of that compared to your home. So if you have a 100 square foot office and 1,000 square foot home, well, that's 10% of those expenses towards your home that you can now deduct from business use of home. So, because obviously you need electricity to function in that office space, internet, yes. So all those expenses you guys are putting towards your home that is also used by the business can count towards that. And you can see that here. And like you said, we really don't look at the depreciation as much. It's
So
kind
do
of,
we do the math or just the accountant does do that?
it does it. Yeah, it does it
Okay.
automatically for us.
So I just
Mhm.
tell them like, okay, I paid $100 a month for Duke.
Mhm.
And and then I use 100 square feet.
Yeah, so
for
it,
my house, and then you do the rest.
yeah, it does the percentage,
Okay.
that space that you give us compared to the entire home.
Gotcha.
Mhm. Yeah. Mhm. So, and even if there's any like direct expenses towards it, like if the light bulb goes out in your little office that you work in, I mean, that's towards your office. I
You
mean,
need a
that's
new
for your business,
ceiling
right?
fan.
So there you
need
go.
a new flat screen TV.
Oh, yeah.
You need new rug.
Yeah.
You
Of
need new
course.
desk.
Yeah.
All
I thought I
that.
had it on
Oh, I
here.
But-
Yeah, and I even put on here like, here's some, because even, yeah, the mortgage interest from that 1098, MIS that you guys get, a percentage of that is technically going towards your business, because that's the space you're using. Your real estate taxes, those utilities, and internet. So I mean, those are usually the four main ones that we get. Yeah, so any questions about that? Here online? That's usually what people, again, want to know is, what can I count? And then vehicle and mileage is another big one. Was this me or you? That was me. Okay.
Yeah.
So when it comes to vehicles, when you start using it for your business, you have to go one of two paths. You either completely go with the actual expenses of the vehicle, which you can see listed in here, some of those things that are included in the actual expenses, or you can go straight mileage. Okay. Typically mileage is the easiest. So I know there's apps out there that'll track it. Or me personally, I'll just type in Google Maps where I start, where I go, where I end, and it gives me the mileage on the actual map. And again, same thing that was just on the other Excel sheet, just track it. Today, I went this many miles. When you do it again, this day, I went this many miles, and then just add it up at the end of the year. Here's a summary, Mr. or Mrs. Accountant, right? So
The app that I use, it like runs in the background on my phone like all the time.
Mhm.
So anytime I get in the car, it's tracking it, and then you don't have to do it every day. You can do it like once a month, just personal or business, and then at the end of the year, it gives you a whole PDF spreadsheet.
Oh, yeah. Yeah, we've gotten some of those PDFs from people before too, like, hey, here's what it was. So, and it's great too, because like Dan was saying earlier, you can use that to track towards, if one of your businesses is your rental properties, we'll track that mileage to and from your rental properties. If you're going for cleaning or some maintenance, do that. And this year in 2023, the mileage rate is 65.5 cents per mile. I don't know if you guys know, last year it actually switched in the middle of the year. It went up, 4 cents, I think it was. It was like 58.5, and then it went up to 62.5. And then January 1 came around, they're like, no, we're gonna up it again, 65.5. So those are good things. So in a way, it's counting as a bigger expense for you, because like everything else, it's more expensive. So that was kind of, I guess you could say, a nice thing the IRS did, which you don't say often, right?
And I'll just
Yeah.
jump in. We do get the question from time to time, should I purchase a vehicle for my business? And that it's a specific analysis that your accountant can help you with. It sort of a tipping point somewhere in the middle is if you have 100% business use. If you're using your personal vehicle and driving 15,000 miles, 100% or 90% of all your miles is related to your business. Or if you're going to look at getting the old rule that probably everyone has heard of is the SUV rule, where if you get a vehicle, a truck or a SUV that's over 6,000 pounds, you get to basically expense or bonus depreciate the full value of that. So, so relatively early when the mileage is far easier to track and it's probably the best method to do. But when you switch over and you're using a vehicle, and especially if you're looking at maybe, doing a bigger vehicle, more expensive vehicle, then there is this tipping point where it makes more sense to take the full value of the vehicle and start tracking actual costs.
That's what I've always done. I've never done mileage, girls. I am not disciplined enough to keep up with that. So
Sure.
Yeah.
I turn my gas receipts in, my tires, my oil, like all that.
Yeah.
And then he deducts like the good thing, if you do have something that's over 6,000 pounds, I do know, because I've always had an SUV because of that. If he's like, oh, you owe money, I'm like, how much can you now depreciate of this SUV? And there's been one year he's, I'm taking the whole thing, which it sucks the following year, but if it's helped not have to pay anything for that year, then it's worth it. And I think you can do that, twice, every 2 years, you can get a new vehicle, I think.
I don't know any rule now. What you need to be, I think what that conversation is, if you fully depreciate it that first year, because you need the whole thing, and then you trade it in a year or two later, you will have some gain.
Yeah.
You'll have to recognize the trade-in value will be gain versus if you wait 3 or 4 years, the gain's almost nothing.
But he can still deduct my tires still, even if I had to deduct the whole value.
Sure.
It's always been better for me to do it that way than mileage.
Sure. Yeah.
Yeah, and it's always a case by case basis too, so. But, I believe,
I
like,
don't
once you
drive
pick,
that far anyways. Like I'm not one of these agents driving to South Carolina and Charlotte multiple times a week. I'm not. doing
You'd be
that.
surprised how many vehicles now are exactly like 6,027 pounds, 6,050 pounds, like they.
How do they know?
If,
I'm sorry,
Yeah.
Well, the car salesperson should do it, would tell you, but if you open the door, there's gonna be a sticker on the door and it'll tell you what the what's it called? Gross weight?
gross vehicle weight.
Yeah, that's right.
GVW.
Yeah.
Yeah.
If you got a car, it's
We'll
not
do it
over,
too.
a car won't be over 6,000 pounds.
I have the Highlander. Yeah.
It probably, it may be.
QBI, that's you.
Okay, and so you sort of know probably the basics of that profit and loss that we showed you on the Schedule C. So the net income, the net profit, back a few years ago with one of the big tax changes, they also gave us something called a qualified business income deduction, QBI. So we basically get a deduction of 20% of that net income, net profit you get to take off of your taxes. It's a nice thing. It's eventually maybe going to sunset and go back to the old rules where you're just taxed on the net profit of your business. But for now, it's a favorable rule, just something to be aware of that. So if you made 10,000, you had 5,000 in costs, so your net profit was 5,000. Well, the IRS gives us one extra line on the tax form, and it literally just takes 20% of that profit away as a deduction.
Win-win. So
What if you get paid 1099 and W2?
it will only go towards that 1099 because that's
Okay.
what that
That's what
specific
the
business is. Yeah.
assignment.
Mhm. Yeah. Yeah. They're not going to double tax you on that
Mhm.
W2. Shouldn't be.
But you already paid.
And so this was just some additional, real estate tips that we thought would be helpful. So obviously with the 1099s not having any federal state withholdings, some of you may do this already where you're paying in your quarterly taxes. That's one way to kind of alleviate, spring, early summer when that tax bill comes around. So that way it's not so much as a burden, or you may not have those funds at that time. So it's good to kind of pay it in throughout the year.
How much would you say, like an estimate? Percentage?
So it's.
That's a tough answer. Yeah.
It's,
Depending on the income.
Yeah.
yeah, so
$5.
Yeah. Yeah, and what we do too is if we notice like there's a trend where somebody has a Schedule C and they have an uptick in profit, and we notice there's a trend like, hey, you're paying, tens of thousands of dollars when tax season rolls around. Have you thought about doing quarterly estimates? And we can project those out. What do you expect the business to do this year? Same, better, worse, and then we can gauge it
You
off
need
of
an
that.
accountant. You don't
Yeah.
need to be doing your taxes. You need to hire these
Yeah, I'm
guys
gonna call
because
them.
you're probably making a mess. of it.
Because, yeah.
Good thing we're all.
Well,
three
you're
of us
right.
here.
You're probably
Yeah.
making a ton of money. If
In the
they're
house,
like, you
right?
don't
Yeah.
have an accountant like I had one before that didn't really know like
Yeah, that's
real
what mine is
estate.
right now.
Yeah, you need an accountant.
Yeah, and it's tough because you are running your own
Yeah.
business,
Mhm.
especially starting out. You don't always know what you can and
Yeah.
can't do. So ask somebody
I
that knows
couldn't
it.
imagine doing my own taxes.
Or maybe
Yeah.
you knew nothing about taxes.
Right. Yeah.
So you're gonna feel like I don't know.
Yeah.
so the technical answer is it's your personal income tax rate.
Yeah.
You could, when we get a brand new client and they say, well, give me just a ballpark. It's your federal and state, so you have to, state's 5%.
Okay.
So that one's easy. Federal is a sliding scale from 10 to 37. So if you wanted to split the difference and say, every now and then, if we're really pushed, and we don't have a history with the client, I'll say, if you can, at least 25%, 20% federal, 5% state. That might be a little over, or it could definitely be a little under, but that'll get you fairly close.
Yeah.
Yeah.
I've even heard people too, like around that 30% range, they get their commission check or whatever. And they're like, I'm just gonna go ahead and slide 30 into this account and leave
Yeah.
it. Like, that's my no touch.
That's
That's what I would
Thing,
say.
yeah.
That's what I did.
Yeah.
Me too.
Right. So,
It's just.
I just feel like at the end of the year,
Yeah.
because I do everything at the end of the year. I feel like that account that I
mhm. Yeah.
And then that way, you know, that money that's sitting in that bucket when you're doing your
It's not
quarterly,
mine.
it's right there.
Right.
You haven't touched it.
Yeah, nothing else out of your pocket. Yeah. And so, some other things to think about, if you're not like, man, I'm just not good at tracking my expenses, then the best advice we can give you is open up a separate account specifically just for that business. If you're commingling business and personal funds, it makes it tough for you, and which means it's gonna make it tough for us to figure out what
Very
exactly
God.
is going on here as far as income and expenses
get
that are
in
actually
trouble for that.
related to your business, right?
Mhm.
So we've even had people that, hey, this card is only for business, and that's all I've used it for all year. Here's my 12 statements
Mhm.
on come tax season. I don't know what to do with it, but here they are.
Yeah.
Okay, and we can run with that. It's gonna take us a little longer, but we can work with that. As a bare minimum, that's what we would suggest.
The bank account and
Mhm.
credit card. If you want to have a company credit card for points or miles or whatever, if you can open a separate card up to run all those business expenses, yeah, you have that option of just handing it all the 12-month statements, and we can figure it out.
And do
from
you
there.
guys help with opening LLCs and S corps also?
So the attorney will, or the website, I know there's some websites that we are, as CPA firm, are specifically excluded from performing legal services, but we can definitely walk you through the tax benefits of an S corp versus an LLC.
So like if one of the agents came here and said, okay, I want you to be my accountant, but I don't know if I need an LLC. I know, because they say you need to close a certain amount of deals to justify the expense of having an S corp or whatever, right?
Yeah.
So you guys could be like, yeah, you're not there yet, or yes, you need to open an LLC and this is what needs to happen.
Yeah,
You're
so
hitting on
that-
number 5.
Yeah.
Okay.
And I made some notes on that. That's a conversation we have a lot with our early business. The LLC is by far the most popular initial step.
Mhm.
It gives you some nice, legal advantages, and then eventually where it moves from a Schedule C, that goes right on your personal return, up to an S corp or an actual partnership, has to file its own tax returns. So there's some tax preparation fees. So we always suggest you do want to get to a certain level of, it really is based on your profit.
Mhm.
And you could sort of I generally recommend about $50,000 of profit in your business activity, because that alone, we can save you, when we file as an S corp, we can save you about 4,000 in taxes. And so even if you pay a separate tax prep fee, that's usually the tipping point. So early on, LLC works great. But as you get more and more profitable, there is a point where and then there's other conversations about whether you should be a partnership or a S corp. And that gets into the weeds of how many partners you're going to want, how much flexibility you're going to need. That
Percentage ownership, all that.
yeah,
stuff,
yeah,
So,
Do you know how to do all of that as well?
yeah. That's that's where we generally don't do tax 1040 tax returns, other than when they're associated with a business, because that's where we sort of spend a lot of our time looking into those issues. We want to have these conversations about tax planning and when to make decisions. That the 1040 return, those, you can do those yourself, or other folks in town can do those. Yeah.
for sure. So, but just some other helpful things I thought might be useful on here. Just if you have just kind of a generic overview from the IRS, there's a couple of videos they have. It doesn't sound very exciting to hear an IRS video, but they're actually pretty short. It's only a couple minutes long, like the small business tax workshop and the business use of home. It'll just kind of briefly explain what they are, how it can relate to you. And then there's another YouTube clip that I have referenced before as far as tax tips specifically for real estate agents. I mean, a couple of books and podcasts that I personally listen to that I have found helpful on the real estate side of taxes. So if that's just depending on what your cup of tea is, as far as how you learn, whether it's videos, books, or podcasts, there's a little bit of everything for you there to kind of sample. But any other general questions?
We had a question during the other session about QuickBooks versus Excel. And I'll just real quickly, Excel is very clear and it's hard to mess up. There's a volume when you have multiple rental properties or just several businesses that you're trying to keep up with. QuickBooks is pretty cheap. You can get that, and there's some nice import features, and you can download things from the bank or from your credit card. But we do, for small business, Excel is really the better option until it gets to be where it's just too much and you're just feel like you're spending way more time. And then QuickBooks, or there's other options.
Yeah, of course. Yeah. And just to kind of like recap too about us, like we do enjoy working within the community. It's nice just from our office, which is down there by, was it Charos? Right across from like the hospital, that big ACN World Headquarters building. We're like directly behind it. We're kind of stuck between a couple medical buildings there, but it's nice just from the drive there to here. I mean, we're passing 3 to 4 businesses that, that we have as clients. I mean, just in this loop around here, there's 3 of them that we either, have personal relationships through our, other clients, or we do audits for and whatnot. So that's what I love about it. And that's why I think this is a good blend, and why I wanted to come here and share this stuff with you guys, because I know it really is about the community, uplifting the people here and trying to add value in some way to each other and our clients. So hopefully you guys learned something of value from this, whether it's just one thing or not. So feel free. It'll be great to have this recording, go back and watch it when you want to go to sleep. But anyways, like he said, feel free to reach out to us. We got locations. I'm sure if there's people on here from Mooresville or watch it later, we have an office there. Great tax advice over there as well. I think one of our main tax gurus, Ron, is over there. He's knows things I couldn't even imagine about the tax code, but we also have an office in Monroe as well. But love to help you guys in any way that we can. So don't be afraid to reach out.
We definitely appreciate you
Thank you.
bringing that up and saying, hey, I can do this for
Yeah.
y'all. And then taking the time to come in here and do this and share. I appreciate it.
Yeah.
And for you answering my question the other week. Appreciate that too. So.
Absolutely. Does anybody have any lingering questions if you actually stayed awake online?
Thank you, guys.
Nice.
Y'all need to take some of this food back to y'all's office.
Gladly.
So there's one whole tray that hasn't been